Welcome back to Investing Talk Podcast.
Great to be back. Today we're tackling a name that I think has been on a lot of watch lists for years. Maybe people even forgot about it.
Right.
But suddenly, here we are in early 2026, and it is arguably the most interesting story in the entire energy sector.
We are talking about energy fuels, ticker UUU. Now, for anyone who hasn't looked at this company since, say, 2024, you hear energy fuels, you just think uranium.
That's it. U.S. uranium, guys.
Exactly. They dig rocks out of the ground in Utah, turn it into yellow cake, sell it to power plants. Simple story.
And that was the story. But if you're only looking at them through that lens today, you are missing the entire picture, a massive picture.
Okay.
Because while everyone was watching the uranium spot price, bounce around, energy fuels has been quietly, or actually pretty loudly lately, changing its whole identity.
How so?
They're becoming what we call a mine-to-metal champion.
Mine-to-metal. Okay, that sounds like a marketing buzzword. It sounds expensive.
It is capital intensive, for sure. But it's the difference between selling, raw ingredients and selling a finished high-tech product. This isn't just about mining anymore.
So what are we talking about then?
We're talking about processing the critical minerals, the rare earth elements that go into EV motors, wind turbines, defense tech, all of it.
So they're moving up the food chain.
Exactly. And the market is finally waking up to it.
Yeah.
I mean, they just crushed their 2025 guidance. Revenue is up over 330% year over year.
Wow.
And the stock is hitting 12-year highs.
Okay, a 12-year high is a serious statement. Usually when a miner tries a pivot like this, the market hates it. There's so much uncertainty, cash burn. The stock usually gets hammered.
It does.
So a 12-year high means something very different is happening here. The market's buying the story.
They are buying the pivot. It's a fascinating situation.
Well, we need to unpack why.
Yeah.
Because 330% revenue growth sounds amazing, but is it sustainable? Or is it a one-off fluke? But as usual, before we start, subscribe, like, and comment to this video to support the show.
We dig through the 10Ks and the earnings calls so you don't have to. So go on, hit that button.
All right, let's get into the fundamentals. You said they crushed guidance. That's a strong word. In the mining world, guidance is, well, it's a moving target. How big of a beat was this?
It was significant. For the full year 2025, they went right past the top end of their guidance. They mined over 1.6 million pounds of uranium.
1.6 million. And just for context, a few years ago, they were barely producing anything, right? They were pretty much in standby mode.
They were. Just keeping the lights on, waiting for the price to come back. So ramping up to 1.6 million pounds is a huge operational flex. But, the more important number, the one that actually hits the bank account, is that they finished over 1 million pounds of U3O8.
Okay, pause there. You have mined and then you have finished. Why is that distinction so important? Isn't it all just uranium?
Not to the customer, no. Mining gets the ore out of the ground. That's the messy part. Finishing means it's been through the mill, it's processed into U3O8, the yellow cake concentrate.
That's the actual product.
That's the product you can sell to a utility. Hitting that million-pound mark means the mill is really humming. It's not just a pile of rocks. It's catchable inventory.
Got it. So the factory's working, and I'm guessing that throughput is why we saw that revenue number just explode.
Precisely. For Q3 2025 alone, revenue was about $17.7 million. That's a 337% increase year over year.
337%? I mean, that's a staggering number. That sounds like a software company, not a miner. Is that just purely volume, or are they getting better prices too?
It's a mix of both, but there's a third piece here that's maybe the most important: efficiency.
Yeah.
Operational efficiency. They've shifted their focus to their lower-cost mines.
Right.
We're talking about the Pinyon Plain mine and the La Salle complex.
Pinyon Plain. I've read about that one. That's the really high-grade deposit, isn't it?
It is incredibly high grade. And in mining, grade is everything. The higher the grade, the less rock you have to dig up and crush to get the same amount of product.
So it brings your costs way down.
Way down. We are seeing production costs in the $23 to $30 per pound range.
Okay, let me put my skeptic hat on for a second here. Because $17 million in quarterly revenue is great, low production costs are fantastic, but at the end of the day, you have to turn a profit.
Of course.
I'm looking at the consensus estimates for 2025, and even with all this growth, they're still posting a loss.
You're absolutely right to point that out. Consensus EPS for 2025 is a loss of about 35 cents. And even looking out at 2026, the projections, they still show losses. Narrowing, but still red ink.
So we have a company with a stock at a 12-year high that is still losing money. That usually sets off a few alarm bells for me. How are they funding this? Are they diluting shareholders to death?
That's where the balance sheet is their main line of defense, and it's a fortress. They're completely debt-free.
Zero debt.
Zero long-term debt, which is incredibly rare in this sector. Plus, they're sitting on roughly $300 million in liquidity and working capital.
Debt-free is a magic word in mining. It means no creditors breathing down your neck.
Exactly. It means they can fund this massive pivot we're about to get into without having to immediately run out and issue more shares. They have the runway.
Okay, so they have the cash to burn for now. Let's talk about that strategy, that mine-to-metal idea. What is the actual competitive moat? Because mining is a tough business.
It is.
What makes energy fuels so different?
To get that, you have to look at their crown jewel,
Right.
the White Mesa Mill in Utah. You really can't overstate how critical this asset is.
Why is that?
It is the only operating conventional uranium mill in the United States.
The only one in the entire country.
The only one. Now, there are other ways to get uranium, but for conventional hard rock milling, White Mesa is the only game in town.
Yeah.
But here's the secret sauce. It's not just for uranium.
And this is the pivot.
This is the pivot. Because White Mesa is licensed to handle radioactive materials, they can process something called monazite sands.
Monazite sands. Okay, that sounds exotic. Break that down for me.
Monazite is a mineral that is just packed with rare earth elements, the magnetic metals and everything from phones to missiles. But here's the catch.
There's always a catch.
It also contains uranium and thorium, is radioactive.
Ah, I see. So a standard chemical plant can't touch it because they aren't licensed for that stuff.
Exactly. For them, the radioactivity is a toxic waste nightmare. But for energy fuels, they want the uranium. They actually extract it, sell it for a profit, and then they separate out the rare earths.
So they turn a liability into another revenue stream.
That's the genius of it. It's a regulatory arbitrage. They're the only ones with the key to that door.
That is actually pretty brilliant.
And phase one of this expansion is already commissioned. But the biggest news, the thing that has the market so fired up, is the recent acquisition of Australian Strategic Materials, or ASM.
I saw that headline. That was a big number, around 300 million, wasn't it?
Roughly 300 million, yeah. The deal should close around June of this year, 2026. This is the real game changer. It connects their mill with ASM's Dubbo project in Australia and, critically, a metals plant in Korea.
Wait, a plant in Korea? Why does a U.S. miner need a plant in Korea?
Because that completes the supply chain. That's the metal part of mine to metal. White Mesa makes the rare earth powder. But to turn that powder into the actual metal alloys needed for high-power magnets, we're talking NdPr.
That's neodymium praseodymium.
The key ingredient for the strongest magnets in the world, yes. And we really don't have that metallization capability at scale in the West. But this Korean plant does.
So the ASM deal lets them bypass China.
That's the whole point, bypass China. Right now, China controls almost all of that processing. This creates a supply chain where the material never has to cross the Chinese border.
A vertical monopoly on the non-Chinese supply chain. Okay, I get the narrative now. I can see why people are excited. Let's pivot to the price action, because the chart is, it's just vertical.
It has been an absolute rocket ship. Year to date, here in early 2026, the stock's up around 180%. It's at 12-year highs.
180% gain in a couple of months is not normal, especially for a miner. This is acting like a tech stock.
It's a pure momentum play right now. It is trading way above its 20-day and 100-day moving averages. That shows just immense buying pressure.
And it's not on thin volume, right? This isn't just retail money pushing it around.
No, not at all. We're seeing huge volume, days with over 21 million shares traded. That confirms institutional interest. This is the big money moving in. It feels like a true breakout.
We have to talk about the valuation. This is where I start to get a little nervous. We already said they're losing money. But what about price to sales? Your average miner is what, 4 times sales?
The industry average is around 4x.
Yeah.
Energy Fuels is trading at a price to sales ratio of roughly 40x.
40. 40. That is priced for absolute perfection. That's a software multiple.
It's expensive. There is no way to sugarcoat that. A traditional value investor looks at this and runs away screaming. But the argument is that the market is paying a huge premium for two things: momentum and scarcity.
Scarcity of what? Uranium?
Scarcity of the trade itself. If you're a fund manager and your mandate is get exposure to a Western critical mineral supply chain, where else do you go?
Not many places.
There's a scarcity value to owning the only real non-Chinese option. Investors are betting that the strategic value of that moat is worth way more than the current revenue shows.
So you're paying for the story, not the current cash flow. Risky game. Okay, so the charts look great, but what's the smart money actually saying? Let's talk sentiment. Are analysts on board?
It's surprisingly bullish, actually. The quantitative score from Alpha Vantage is a 5 out of 5. It's flashing strongly bullish.
That's the news cycle. What about the actual analysts writing the reports?
They're positive, but honestly, the price is moving faster than they can update their models. Roth Capital has it at a neutral or hold, mostly because it ran up so fast.
So they like the company, but the stock got ahead of itself.
Basically, yeah. H.C. Wainwright is still at a buy, but their target is around $26, $27.
Mhm.
The stock has already blown past some of the older targets that were the low 20s.
Right. What about the institutional flow? Who's actually buying?
Well, we've seen some insider selling, which you'd expect after a run like this, executives taking some profits, but the institutions are accumulating.
Any big names?
Yeah, we're seeing increases from Vanguard, Van Eck, Universal Beteiligung's also upped their stake quite a bit.
And what's the narrative they're buying into? Is it just the rare earths story?
It's that plus a huge government angle. The market is all over the Department of Energy sport narrative. The DOE has a $2.7 billion push for nuclear fuel security.
2.7 billion? That's a lot of government support.
It is, and Energy Fuels is perfectly positioned to be a primary beneficiary. When the government decides something is a matter of national security, you generally don't want to bet against it.
That makes sense. Don't fight the DOE. But we have to look at the downside. What kills this rally? A stock at 40x sales that isn't profitable. Let's dig into the bear case.
Okay, first reality check is what you said. Profitability. They aren't there yet. Net income for the trailing 12 months is a loss of roughly $97 million.
Nearly 100 million in the red. And they're spending a ton of money.
A ton. The White Mesa Phase 2 expansion is a $410 million capex. The ASM acquisition is another $300 million. These are massive, capital-intensive bets. If execution stumbles, that cash pile starts to shrink very, very fast.
And mergers are never a sure thing. The integration risk has to be a concern.
It's a huge risk. This ASM deal involves assets in Australia and Korea managed out of the U.S. You have different time zones, different regulations, different cultures. It's complex. And the deal doesn't even close until June. A lot can go wrong.
Plus, at the end of the day, this is still mining. Permitting is always the boogeyman in the closet.
Always. You can have a great feasibility study that proves the economics on paper, but a regulatory delay from the EPA or a local agency can push your timeline out by years.
And a market that's priced for perfection absolutely hates delays.
Exactly. And at 40x sales, with an RSI near overbought, any disappointment in their next earnings report could trigger a massive correction. Not to mention the commodity risk. Uranium's at, what, $91 right now?
A great price for them. But if that drops back to 50,
their entire revenue model gets thrown out the window. They still don't control the global price of their main commodity.
so high reward, but very high risk. It feels like they're walking a tightrope. You have to believe in flawless execution. So with all that in mind, the run-up, the pivot, the risks, what's the final verdict?
When I weigh it all, I'm giving Energy Fuels a bullish score of 8 out of 10.
An 8 out of 10, that's pretty confident given the valuation. Why so high?
It really comes down to the uniqueness of the asset, the moat. The combination of crushing their uranium in guidance while also building this strategic dominance in rare earths.
Yeah.
It just makes them a one-of-a-kind company.
Hmm.
It's not just a mining stock anymore. It's the premier play on the whole U.S. energy independence theme. There's just no other way to get that kind of exposure.
So you're betting on the moat above all else. What's the thesis for a listener then? Is this a quick trade or a long-term hold?
This has to be a multi-year hold. The horizon is 2026 to 2028. You need to give them that time to close that ASM deal, build out phase 2, and really get that new supply chain humming.
But with the chart looking like a straight line up, do you buy right here?
You know, ideally, you're looking to buy on dips. The volatility is going to be high, so you'll probably get a better entry point. But the long-term story is absolutely intact. They're on a path to 4 to 6 million pounds of uranium capacity while this entire REE business comes online.
Right.
If they execute, this is a completely different company 2 years from now.
So buckle up for a bumpy ride, but keep your eyes on that 2028 horizon. It's a fascinating story. A legacy miner trying to reinvent itself for the modern tech age.
It really is. It's one of the few infrastructure plays out there that actually owns the critical assets to back up the story.
Well, there you have it. Energy Fuels, high stakes, sky-high valuation, but a potentially massive payoff if they can pull off this mine-to-metal strategy. Don't forget to subscribe, like, and comment. We'll see you in the next one.